Good afternoon, everyone. Welcome to the CBIA Leadership Series. Today, we're going to review the 5 C's of credit, which is a universal framework for commercial lenders used in evaluating new loan requests. My name is Michelle Orr. I'm a senior loan officer for Live Oak Bank, and we are a national SBA lender headquartered in Wilmington, North Carolina, and established in 2008. I've been an SBA lender for over 20 years now and mainly cover the Northeast market. I live here in Connecticut. So some housekeeping items before we dive into the presentation. Everyone's in a listen only mode. So if you have any questions as I'm going through the slides, please feel free to type those in the chat. And I will address those at the very end of the presentation. And then if you have additional questions once we've ended, you will see my contact information at the end, and you're welcome to reach out to me anytime. So with that, we'll get into the presentation. I just went through who we are, so this is just an overview of what I just said about Live Oak. Okay, this is an outline of the 5 C's of credit, and we're going to drill down into each one, but basically the 5 C's are character, cash flow, capital, collateral, and conditions. So the first one we're going to drill down to is character. And character is basically, who are we lending to? What is the honesty and integrity of the person we're lending to, their background, their experience in the industry in which, they're trying to either open a business or buy a business. And then the personal credit score, because, as a lender, we perceive somebody's credit history as a good indicator of their willingness to repay a new loan. And so that's why lenders, look at credit history pretty much on all loan requests. So in understanding your personal credit score and what's on your credit report, which I highly encourage people to check that once in a while, is your payment history, how much revolving credit you have used and what's available, the aging of accounts, any collections that may be outstanding, any personal bankruptcies, and any outstanding liens and judgments. So on the side, you'll see what we consider to be strong and then moderate and weak credit scores, ranging from 850 to below a 600. The next in the 5 C's is capital. So that is referring to what your investment is in the company. If you're buying a business, that would be your down payment to purchase the company. If you have an existing business, then that would be the capital that you've already invested in the company. And so if it's a new business purchase, we would request a personal financial statement to see how much cash you have available to inject into the acquisition. Okay. This is a sample of what's on a personal financial statement. So it's basically your assets and liabilities and then net worth. Okay. The third C is condition. So what that means is, what is the loan going to be used for? Some common reasons for business financing include refinancing debt, working capital, construction, purchasing a business, buying real estate to occupy with the business. So that's basically what condition represents. And then cash flow is the 4th C. So the cash flow that's available to repay the loan is what we're referring to here. And to analyze the cash flow available to repay the loan, we look at the last 3 years and year to date. So last 3 years tax returns, and then year to date profit and loss statement, so that we can calculate the cash flow that's available to service debt. And if the business has any outstanding debt, then that would also be factored into what's left to repay a new loan. So cash flow, we're going to drill down a little bit here. So basically the business takes an income from a product or service sold to its customer. So that income, that comes into the business, and then the business pays all its expenses, and whatever's left over is what's available to service any debt. Okay. And then collateral. So if you can't repay the loan, then sometimes there is collateral, sometimes there's not. So collateral refers to any fixed assets that are available to secure the loan, such as equipment and real estate. In this slide, it says retirement accounts. In my world, we don't attach retirement accounts for an SBA loan. We don't take that as collateral, but in other types of lending that may occur. So the amount that's required for down payment on your loan request depends on, what you're doing and what product you're using. In the SBA world, the typical down payment is 10% for a business startup or a business acquisition, buying a business. Real estate, we can usually go up to 100% financing on real estate if it's for an established company and not a startup. Some conditions that factor your ability to obtain credit include local, national economic conditions, industry outlooks, and competitive position. So, one of the conditions that we all experienced recently was COVID. And so I know a lot of lenders kind of paused on lending to certain industries that were negatively impacted by COVID. So that would be a very good example of conditions in the market that could prohibit or make it harder, more difficult to obtain credit at a certain point in time.